Welcome back to our weekly urgent macro market updates, where we go over all of the most pressing things that happened in the macro and crypto space over the past week. We go into some really interesting things today. We talk about the job market. Despite what the governments tell you, it is not looking good, and how that could affect you, potentially your employment, and what that's going to do for the entire market. We're also going to talk about earnings. Those reports have been coming in, and even though they've seemed really strong so far, in this episode, we go into exactly why that has to come down realistically and what that's going to mean for the market and specifically for all of our portfolios.
Big things this week in regulations. Obviously, stablecoins are what were in the news. We had a hearing that was mostly along party lines. Democrats vocally against stablecoin bills. We had the Republicans led by Chair McHenry really supporting regulation. The interesting thing is that we had the bill drafted by Maxine Waters, a Democrat, Patrick McHenry, who was a Republican. Before the FTX debacle, it seemed like this bill was going to be something that could help the industry move forward. But the issue is now the bill came out last Wednesday, and we had a hearing this past week. Now Maxine Waters is saying, hey, I wrote this bill, but it's not good anymore. We have to go back to the drawing board. We also had Gary Gensler getting grilled by the House Financial Services Committee. There was a lot of discussion there, from, hey, what were you doing with FTX? What were you doing with SBF? To, hey, is Ether a security?
There's a statute of limitations to pronounce something a security, and that Gensler doesn't want to say yes or no, it's a security, because he's in a really interesting predicament here, where he can't technically pronounce a security because it's past the statute of limitations, so he won't. But also, if he did, he knows he probably wouldn't hold a lot of ground, or he'd have a really hard time upholding that. Have you heard anything like this?
I think it was really interesting that he outright would not say Ether is a security in a hearing where he was under oath, because he said it multiple times outside of places where he's under oath. He said everything but Bitcoin is essentially a security, right? So what the SEC is generally trying to do is set broader precedent by, they're attacking these smaller exchanges, these smaller tokens, and they want to get legal precedent on the books. So when they go after potentially the bigger tokens, they have those legal rulings. And I think it's very clear what his end goal is. It's to almost legislate all of these different tokens and all of these exchanges and try to get them under the SEC's purview.
We also had Chamath on the All In. He said that crypto's dead in America. But then I realized what he meant by it was literally just from a legislative perspective.
For me, I think it's very clear if we get another Democratic Party-led Senate, House, presidency, that it's going to be very challenging for crypto to find any meaningful legislation in the U.S. I mean, you've seen it not only from the Senate, from the Elizabeth Warrens of the world, but now from the House. You could see Maxine Waters is falling in line, all the way up to the presidency and all of the high-level things they've released. It's very clear that someone in the administration is saying crypto is not welcome here. So we're going to get into jobless claims here. We're going to pivot back to the economy. The Fed is obviously trying to get jobless claims to rise. They want wages to fall. They want that inflationary pressure to sort of subside across the board. You can see here on the slide, you have jobless claims up above 250,000 folks per week. If you were to look back at previous recessions, an average recession is something like 600 to 700,000. That's what we saw in 2008, 1982. If you look at other sort of more mild recessions, you have 400 to 500,000. So we're still way away from those numbers, but they are starting to rise. They're starting to move towards where the Fed is looking for them to get. Broader economy here, we're looking at sort of manufacturing, one of the key leading indicators on how things are trending more broadly for companies. This has a strong correlation to recessions. So you can see here we're in negative territory for manufacturing activity, and we continue to see companies rolling over with not only the prices they're paying, but the orders they're producing and all of the things that kind of feed into this broader manufacturing index. So all of this, what we're really focusing on at the end of the day is coming back to how are these companies driving profitability and how they're developing their earnings. And all of that leads into, hey, is there a potential recession coming? And what does that mean for risk assets? Earnings season has just kicked off, and we've had a handful of companies report. The last sort of indicator I just showed you, the manufacturing indicator, you can see trends pretty strongly with the amount of companies that are reporting earnings up and above what they initially projected. So they say, hey, our earnings are going to be $1 per share. And they say that in the beginning of the year. And then, later on, they report $1.25. That's an earnings beat. Great. Things are more positive than we initially expected. Things are not going good on the manufacturing side with the real numbers, and companies are still beating expectations based on where they set them at the beginning of the year. So that should tell you that things are not as they seem right now. And sort of why is that? It's because companies are still sort of wildly optimistic for what the inflationary environment and what the earnings environment is. So two charts here. Right side, you can see profit margins. So how are they able to beat expectations? It's because they've raised prices up and above inflation and actually said, inflation's high, so we're not going to raise things, whatever 8, 9, 10% that inflation is. We're going to raise them 20%, and people are willing to pay those prices to date. But looking forward, it's going to be really hard for people to continue to pay those prices as sort of wages come down, as excess savings is rolling off. So that should tell you that things are, not as they seem, and potentially we could see some real turbulence going forward, as we talked about in the last video.
You have jobless claims increasing. You've got cost of living and cost of goods increasing. Salaries staying pretty much the same or slightly, but not even enough to keep up with inflation. And so it's inevitable that the consumer purchasing or consumers be able to purchase. Not only that, but credit card debt, I think at near all-time highs, with over $1 trillion in credit card debt in the United States alone. These are all reasons that spending will go down. Yeah.
And those pressures take time, right? It doesn't just happen in sort of 1 week. You have bills that keep rolling over months, and it takes time to get there. And we'll see that a bit on the next slide. I think the final point to hit on here, though, is that while we see these are estimates for earnings and revenue for companies, you can see Q1, Q2, everyone's kind of projecting they're going to dip, but they're also projecting that we're going to immediately bounce back to sort of all-time highs. So you see this rosy picture that analysts are projecting, when if you look at the broader economic data, it doesn't support any of that, and the consumer does not support the ability to pay for all of those things.
So what do we see from here? If we're at about 19 or so X from price to earnings, if we see that come down just to 14X, like what percentage drop is that? And then, that's in stock market, right? So then probably much deeper in crypto if we still have a correlation to the stock market, which we historically always have had.
If we were to drop from 19 to 14, the average recession right now, you see stocks decline 20%. This re-rating would mean 30, 40% stock declines. Crypto is still very correlated to equities. You can see that in sort of almost any chart you look at, particularly, high risk tech equities right now. So you can see crypto continue to decline 30, 40%. It remains to be seen whether the rest of big sort of crypto assets like Ethereum and others will actually follow stocks down if they do sell off. My view is that I think Bitcoin will likely hold some water given its risk off characteristics that we've seen thus far. The tricky part, I think, is that it might take some time, because household balance sheets are actually still in the best shape they've been in a very long time. You can see this is net debt to overall wealth. We're at, 12, 13% here. It's very much in line with, some similar historical periods. And that before the 2008 financial crisis was actually at like 24%.
What does that mean, household balance sheets?
Yeah, so that's household debt. So if you think about a normal person, at least in the US, most of their debt and the amount they owe is in their mortgage, right? So folks have been able to take out very low interest rate mortgages. They've been able to do that on a fixed basis. And, a lot of the inflationary pressures have yet to sort of filter into their actual, day-to-day spending. So you've seen it go up here. You've seen, costs for housing go up. You've seen credit card debt go up. But it's going to take a little bit more time. And it's certainly nowhere near the levels we saw in 2008. And most of that is because housing. So, you're going to see, some pain on the consumer side, but they have the excess savings buffer to sort of stem it off for at least a little bit. Putting all this together and thinking about how the stock market thinks about these things, when conditions are, extreme for companies, when you have earnings issues, when you have broader economic strife, you have volatility in the stock market. That means, stocks go up and down. So you can see here on the chart here, the bottom line is the VIX, that's the stock market volatility index, which I think most people are familiar with. The top line is the bond market volatility index. And you can see that the bond market volatility index has spiked precipitously. Bonds are generally considered, quote unquote, the smarter money. They're a deeper market. They're more widely traded. They're highly correlated to economic activity. And stocks generally tend to be more of a lagging indicator. So you can see here, bonds are saying, things are not okay right now, and stocks are still saying, okay, things remain in good shape. So I think you see a lot of the stock market volatility start to filter through, in the next few weeks and months. And if you look at sort of Fed pivots in the past, volatility has actually led that. So if you have strong stock market volatility, then you're going to have a Fed reconsider what's going on in the market and potentially start to at least pause or pivot as we start thinking about these next few meetings.
Does that mean that we're going to turn into a more quantitative easing type of methodology again, or what is that? It's because we're talking about when something breaks, then the Fed's going to pivot, right? So in this situation, are we saying something breaks?
Something always breaks when the Fed hikes. Every single time, particularly in a cycle when we've had the fastest rate hike environment, ever. The tough part is the Fed is actually trying to enact quantitative tightening. So it's running down its balance sheet right now, $95 billion a month. The reason we're not feeling that is because of the broader liquidity picture, which you can kind of see on this slide. You've had the Fed, continue to sort of run down their balance sheet, at the Treasury because they need to do so ahead of the debt ceiling. You've also had other central banks provide positive liquidity. You can see China right here on this slide. This is liquidity, the last 3 months rolling. China keeps pumping money in. Japan keeps pumping money in. So we have a broader liquidity picture that's extremely positive. The more challenging thing is, okay, what happens when everyone stops providing liquidity and the Fed continues to potentially run down its balance sheet at $95 billion a month? Then you potentially get something breaking. And then you have the pivot to, okay, we can't run the balance sheet down. Oh, wait, let's think about quantitative easing. Let's think about yield curve control and all of those other good things. But, we're actually the opposite of quantitative easing right now. We're tightening, and we just don't feel it because of all of this liquidity that's coming into the market.
And last week you said something about the fact that the Fed is almost out of their savings from the TGA, right?
Yeah, exactly. So the Fed, has a bank account, the Treasury has a bank account at the Fed, and they essentially fill it up, and then they pay out for all the programs that they need to over time. One big part of that is actually tax receipts. So you have tax receipts coming in. We just had tax day in the US, and you have a few $100 billion kind of filling up that bank account. Tax receipts in the US year to date are precipitously lower than they were the past two tax hikes, two tax periods. So that means that bank account is less full than it otherwise would be. So the Fed, to fill that, needs to start issuing more debt. They can't issue more debt because we've reached the quote unquote debt ceiling of what they're allowed to raise. So, in the past, we would have run down that bank account based on historical precedent sometime in kind of August. That date is moving forward because tax receipts were not as strong as we thought they would be. So it's likely we get a debt ceiling sort of, the Fed increase, or the government runs out of money, in sort of June, July. So, we'll see that period kind of, move around as more tax receipts kind of come in. But June, July is when the real showdown is, and, when we're going to see potential fireworks from markets.
And so when you say June, July, we see fireworks to the markets, is that a good thing or a bad thing?
I think we've all seen the charts of M2, global liquidity are almost one for one correlated with risk assets. If you have real net liquidity drawdowns, and then you have an earnings recession and all of those other bad things we've been talking about on top of it, you're going to see some real fireworks to the downside for markets. And we're going to see what other tools the Fed can try to figure out to pull out of its hat, right? It's all of these random facilities they're throwing out. It's, quantitative easing. It's, we're going to see what they can do. But I don't think it's going to be broadly supportive of markets, especially if we don't see inflation coming down, because there's no way they want to continue to stimulate, if inflation is still at 5% or so, right? They want it to come down. And as we talked about last week, they want unemployment to go up. They want a recession. They just don't want to tell you that.
Right.
So, we need all those things to happen to actually get inflation down.
So it'd be a good idea if you're heavily exposed to risk assets to maybe consider taking some stuff off the table before June, for example, maybe even sooner.
It's really hard to meet the hurdle rate of 5% bonds right now. You can buy 3-month T-bills for 5% and sleep really good at night. I find it really hard to take risk elsewhere right now with all of the underlying things that are going on. That being said, I think hedging with Bitcoin and other crypto right now is still a strong play because you've seen those characteristics that it now has. You can see the correlation between Bitcoin and gold. So XAU's, the gold index, almost one for the past year. So Bitcoin is actually performing like a risk-off asset. Gold is, a very tried and true risk-off asset. So
what was that correlation with gold for Bitcoin prior years?
So if you look here, it's actually flipped negative at points. So this is the red line here, correlation over here. You can see it's actually flipped negative at points. But historically, it's actually remained. If you look over here, it's fairly negative over time. It does move positive in sort of certain periods, but this is a more consistently positive environment we're seeing, which is fairly unusual.
And just to be clear for anyone watching, positive correlation versus negative correlation, what does that mean?
So positive correlation means the assets move together. So gold goes up, Bitcoin goes up, gold goes down, Bitcoin goes down, which would mean the assets, are perceived similarly in the market. I think the interesting thing as we are thinking about allocation more broadly is, okay, if you get risk-off environment, you have risk-off assets kind of selling off, that's stocks. Traditionally, we would think of that as crypto. Does that mean you can see Bitcoin and other sort of cryptos sell off? Potentially, but if you look at the actual holders and the composition of those holders, you're at the highest amount of long-term holders we've ever seen for Bitcoin. Those are the diamond hands folks. Those are the never sell folks. Those are the Kyles of the world who have had their Bitcoin since.
That's 14.16 million.
Yep, exactly.
Is that 6 months or more?
So this is actually, I think it's 1 year or more.
Wow, that's insane. I always talk about the fact that, like, out of all of the volume of Bitcoin every single day, a lot of that, I don't know what if it's 95%, it's trading, right? But some percentage of that, I don't know whether it's 1%, 5%, 10%, goes into diamond hands, right? Every single day. Some of it is bought and with people no intention of selling it. So it just has to increase over time because there's people like me and Michael Saylor and other people who are just never going to fucking sell their Bitcoin forever, right? And just so long term. So that's surprising considering the fact that the total circulating supply of Bitcoin is somewhere over 18 million right now. And they expect that somewhere between, 2 to 4, some people even say 5, it couldn't really be 5 million, but somewhere between like 2 to 4 million Bitcoin have been lost forever. And so we're saying that, like, there's very, very, very little Bitcoin actually circulate. That's insane. That's extremely low.
And this is honestly one of the pushbacks that I personally have when folks say, hey, we're going to start spending and sort of transacting in Bitcoin. It's because, do you really want to spend your Bitcoin if you think it's going to go up? If you held it since 2012 or something like that, like probably not. So,
there's very few of us out there. People who don't have fiat and you're all in and you make your money in crypto, then you kind of have to spend it. But other than that, I mean, there's very few of us out there, right?
More broadly, people are thinking about dollar alternatives, whether that's Bitcoin or, some of the BRICS currency that you mentioned. You could see right here that, interest in sort of non-dollar denominated assets has hit an all-time high. Tweets, articles, everybody's talking about it. It's in the zeitgeist. As we talked about last week, I don't think it's happening anytime soon because there's no real alternatives yet, but people are considering it. And that's the first step, especially in a world we live in today where things move really fast. So, definitely something to watch, especially as CBDCs are rolling out. You have hundreds of central banks looking at CBDCs. On the left here, you have all of the banks that are looking through. You can see not only research, but pilot to proof of concept of a CBDC. There's only 3 banks that have so far launched one. So you have Jamaica, Bahamas, Nigeria. Those are, not the first world countries we would sort of think of that would be leading this technology. But, the pilots are out there. The real world use cases are out there. And you can see that in particular with China. They're actually starting to pay, some folks in particular provinces, it was just released today, in CBDC. So they're starting to roll this out, and they're moving towards a cashless economy.
This is really interesting to see the actual, I've never seen this before, the technology that they're building on. It's nice to see that there's like some of them are like Ethereum, you got XRP, I guess, on there, R3 Corda. Not like most of them aren't really decentralized. I have no idea what DSC is or DL3S, probably some centralized thing that's created by them. Also interesting to see that some are DLT or distributed ledger technology, some of them are not.
You know, it makes sense, right? I mean, you've seen, you know, a lot of so this is a speech count from all of the different central banks. You can see the sentiment is positive and it's moving, you know, towards that, whatever technology they use underlying. It's because, you know, a CBDC at its core is power. You can control how your underlying population spends money, and you could control how and if they spend money. So as the China CBDC has been rolled out, and the pilots, you can actually see what they're doing. So they're targeting specific sectors. So they started rolling out, you know, specific payments around the Lunar New Year, and they said, "Hey, we're going to give, you know, caterers more money, and we're going to inject money in that part of the economy because it makes sense for this time period." And you can see, you know, all of that sort of filter through the broader economy moving forward. You know, the challenge is when they say, you know, things you can't spend money on, right? So, you know, we don't want you to spend money on whatever, alcohol, cigarettes, or, you know, gambling or whatever. And the surveillance level they have there, that's when it becomes the next challenge. But it's the ultimate tool for observation and for surveillance, which is the, you know, exact opposite of everything that crypto is.
I feel like, I feel like United States, most of Europe, China, they're not going to rule these things out if it's not the intention to be used by everybody. There's no way. I don't think they're going to make an alternative and say, hey, you can use traditional cash, or you can use this like highly surveilled, like non-privacy enabled currency where we get to watch. There's just no way that people are going to be, you know, that people would want to use this, I feel like. Although they will sell it, but then a very nice kind of wrapped up package and say, hey, like, you know, doing taxes suck. Like, you know, you want to not have to do that anymore. You know, let us take over, and like, you won't have to do taxes anymore because they'll have a very clear, you know, idea of everything that you're spending and, you know, what you should be paying on taxes. And like, that's nice for a lot of people, for the people who kind of still trust government and, you know, and want them to not. So like, it'll be wrapped up in a nice package, but usually it takes some sort of, and probably will, right? And it's probably going to be, like I've said before, many times on this channel before, like, it'll probably be some sort of huge recession where everyone's in pain, and like they need some sort of, because you can't just implement something that's so invasive on a mass group of people that are in a calm state of mind where they can rationally kind of assess if they want to use this or not. They're going to need some type of hysteria and pandemonium, I think, to usher in something like this where it seems like they're doing something good, just like the Patriot Act, and like, oh, terrorism, let's fight terrorism, let us spy on you, terrorism, you know. They'll do the same for this, I'm sure.
In the US, we're going to have an awakening and a real rethink in these next few years.
We did have one question from the commenters last week, and guys, if you have any questions, make sure that you leave them down below, and Tom and I can get into them next week. But the question was from Xander, and he was asking about gold-backed cryptocurrencies as it's the easiest way to buy gold. You know, I also have the same question, as that's how I've been buying gold lately, as I wanted to have some sort of diversification and a hedge. And so, you know, from Master Ventures perspective, we did buy some gold. We chose to do Paxos gold just because I think that if you look at historically Tether versus Paxos, I think Paxos has a more regulated and I think transparent type of reserve versus Tether. But I guess just to answer the question, like, is that a pretty good way to get into gold, or would you suggest like really trying to go out and buy it physically? What are your thoughts on it?
Yeah, I think that's certainly a nice alternative. It depends where you have your money, right? If you have it on chain already, it's easy to buy something like Paxos Gold. If you have it, you know, in your brokerage account, you know, you can buy just GLD or something like that. I think the broader point, though, is just how you think about your assets in a portfolio perspective. And this becomes a personal challenge for me. It's like, hey, I got this money in crypto, I have this money in like equities, I have this money in my savings account. Like, how do I look at the holistic picture and see like, okay, how much exposure do I want to gold? Is it 20%? Is it 25%? And thinking about that more broadly. And then your preferred place wherever you have your cash, I think is the way to go. I think certainly on-chain options are fine, and they've seemed safe. You know, to date, I think we've all seen that there are certain risks still on chain that don't present themselves in traditional financial markets. But if that's where your money is, you know, great. You probably introduce a little more risk than traditional savings vehicles, but I don't think Paxos is going under, hopefully anytime soon. Knock on wood.
And I'm gonna plug my friend who actually made me this ring, which is super awesome. Yeah, there he goes. Super cool. And I think that there is like for me, I'm interested in doing some sort of like physical gold stuff, but I'd rather have it on me. And I also think it's interesting because I'm one of these kind of like end of the world apocalypse things where I always want to be prepared to kind of like run out the door and like, you know, in case World War III breaks out and like we need to get out of the house really quickly. But it's also easy to travel across border with gold around your neck or, you know, on your hand or a bracelet, whatever. So if anyone's interested in who made me this awesome Master Ventures ring, you know, let me know in the comments below. I can make an introduction. I think it's a really great way to kind of have physical value on you, which you can always carry anywhere and get anyone will buy gold or diamonds anywhere in the world without question, right? So it's a really good, you know, viable alternative. In fact, more people will probably take gold around the world than they would Bitcoin. So that's another way to kind of store your assets and store your wealth.
Totally agree. I think, you know, the broader theme is, you know, defensive assets, whatever you're going for. It's treasuries earning 5%. It's whatever, you know, your allocation to gold, it's your allocation to Bitcoin.
All right, Tom, thanks for coming on. Appreciate the market insight. Guys, if you want to know anything on next week's show, let us know in the comments down below. Hope you found this insightful. Make sure that you subscribe to the channel if you're not already. Like the video if you like this content. Catch you guys in the next one. See ya.